Welcome back. The headline narrative right now is, well, it's all buoyancy. Equities are flying high, anchored by those mega-cap tech names, and the VIX is calm. It all feels a bit easy.
Almost too easy.
Exactly. But our sources this week, and we've got a stack of institutional data, derivatives reports, funding market analyses, they're painting a radically different picture. We're looking at a market with sentiment officially pegged as neutral. But beneath that surface calm, we are seeing the sophisticated players hedging against this subtle yet pretty acute fragility. So our mission today is to move past the headlines and really uncover the actual mechanics, the things driving liquidity, and, more importantly, the hidden risk. We need to look at tactical futures, volatility, term structure, and this is the big one, the alarming stress emerging in short-term funding markets.
Okay, so let's unpack this. Why are institutions signaling stress when the market looks so confident? It's the paradox of the current environment. We are technically in a risk-on phase. The momentum is just undeniable. But it is built on a foundation of, well, very narrow market breadth and some really aggressive rate cut expectations.
Okay.
So institutional money is focused on two things. First, identifying the exact points where retail or, momentum traders are being trapped. And second, watching the derivatives market for any sign that the cost of hedging is spiking, even if the absolute level of fear remains low. This requires looking at the order book and the overall financial plumbing at the same time.
That's exactly where we need to start then, the order book itself. Let's look at the futures contracts right before the open. We're talking about the S&P E-mini ES, the Nasdaq NQ, and the small cap Russell 2000 RTY. For anyone new to this, those are the battlegrounds.
Yeah.
So what specific metrics should you be monitoring in these contracts to, to gauge the market's health?
We always begin with liquidity. It's the lifeblood of the market. We are scrutinizing the bid-ask spreads and the depth of the order book. When you see those spreads widening out, it's a direct signal. It means liquidity is deteriorating. It also means your transaction costs are higher and price swings are going to be amplified. That's a red flag.
Okay, so wider is worse.
Definitely. Conversely, tight spreads with substantial depth, that indicates a healthy liquid market. But here's the key analytical nugget. We look at one-sided depth.
One-sided. What does that mean?
It means if one side, the bid or the ask, is stacked much, much deeper, it's not organic retail interest. It's often institutional positioning, signaling precisely where they intend to defend a price level or where they plan to kick off a breakout.
So it's about discerning that institutional conviction. And that conviction really shows up when we examine inter-index divergence. You can't just look at the ES alone.
No, absolutely not.
Why does that relationship between mega-cap tech in the NQ, the broad market ES, and the small caps in the RTY, why does it tell us so much about the quality of a rally?
Because it tells you whether the market has breadth, or if this is just a handful of giants carrying the entire index. If the Nasdaq, the NQ, is significantly outperforming the S&P, the ES, that points squarely to a sector-specific driver.
Like AI.
Like AI or some other major tech catalyst. It's a massive bet on growth. But if you look at the RTY, the Russell 2000, which is the barometer for domestic economic health for smaller businesses, and it's showing weakness while ES and NQ are firm.
That's a problem.
That's a massive warning signal. It tells you the rally is shallow, it tells you the big money doesn't trust the broader economy, and it might be signaling a shift away from domestic cyclical plays. It means the Titans are winning, but the infantry is struggling.
That's a fantastic distinction. Now, let's talk tactics institutions use because they impact every trader watching the screen. We've seen specific references this week to trap traders and liquidity grabs. What do those terms actually mean in practice? How are they bowled off in the futures market?
These moves are, they're designed to capitalize on predictable behavior. So take the trap trader. This happens during what we call a failed breakout. The contract, let's say the ES, it breaks above a major resistance level overnight, a previous day's high, for example, and it sucks in all the momentum buyers who think the breakout is real. But then, with very little follow-through, the price quickly reverses. It plunges back down into the range, and those buyers, they are now trapped above that key level. The speed of the reversal, and you'll see a surge in volume on the down move, confirms a conviction behind the institutional trap.
So they essentially use the retail momentum
to fill their short orders at really good prices before yanking the rug out.
So the initial move was nothing more than bait, just to lure in all that long exposure.
Exactly. And the liquidity grab is the mirror image, and it often happens on the low side. The price will briefly extend just below an obvious overnight low, where most people place their stop-loss orders, with almost no sustained selling conviction.
Just a quick poke.
Just a quick poke, designed to trigger those stops. The crucial tell is watching for a disproportionate volume spike right at that extreme low, and then an immediate snapback higher. They grab the liquidity offered by the stops and just reverse direction. It's how the large players fill enormous orders without moving the market too much against themselves.
That insight transitions us perfectly from watching price action to watching risk pricing. Let's talk volatility, specifically the VIX. The overall level is pretty subdued, right? It's hovering in the mid-15s, down from 16.34 last week.
It is.
Is that level, mid-15s, truly signaling complacency, given everything else going on?
In absolute terms, yes. I mean, mid-15s is comfortable, below 15 is outright complacency, but mid-15s, especially heading into a major central bank decision, suggests the market is not worried about immediate disruption. However, the VIX level is just the surface. You have to introduce the VIX term structure as the true diagnostic tool for institutional concern.
Right. Explain the term structure for us. Why does the cost of insurance 3 months from now matter relative to the cost next week?
Think of it like buying car insurance. Right now, the VIX futures structure is showing what we call Contango. It's upward sloping. This means insurance contracts for next month, or 3 months out, are more expensive than the current front month contract.
And that's normal.
That is the normal, healthy state. It suggests we expect volatility sometime in the future, but we don't expect a sudden accident today. The massive red flag is backwardation. That is when the near-dated futures become more expensive than the long-dated ones. It means traders are paying a huge premium for immediate protection. It signals immediate stress, fear, panic.
And we're not there now.
We are firmly in contango now, but even a flattening of that curve or any move toward backwardation in the shortest end demands attention. It shows a sudden institutional concern about imminent stress.
And what about the VIX of VIX, the VVIX? Why do we care about the volatility of volatility itself?
Because the VVIX measures the uncertainty about the VIX future direction. If the VVIX is rising, it means traders are becoming increasingly unsure of where the VIX will trade next. It suggests that while the VIX level might look calm at 15, the potential for a massive sudden swing in volatility is going up.
So it's the calm before a potential storm.
Exactly. It reflects that underlying systemic uncertainty we mentioned earlier.
Okay, let's pivot to the macro drivers that are underpinning all this confidence. What's giving the equity market the belief that, 6,870 on the S&P is sustainable? It all seems anchored to the Federal Reserve.
It is.
We've priced in an 87 to 88% probability of a 25 basis point rate cut at the upcoming FOMC meeting on December 10th. That's huge.
That expectation is everything. It's pure fuel for risk assets. That 16% year-to-date gain in the S&P 500, peaking near 6,870, is a direct result of that dovish conviction. But let's not forget the crucial context. That rally is intensely concentrated. It has been driven by a very narrow selection of mega-cap stocks since October 2022. If the Fed disappoints, or if that narrow leadership falters, the technical structure of the market is highly vulnerable to a sharp correction.
And when we look at the traditionally defensive assets, the U.S. dollar and Treasury yields, they're confirming that risk-on narrative. We expect dollar weakness if the Fed is easing, and that's what we're seeing, isn't it?
Absolutely. The U.S. dollar index, the DXY, has softened significantly, pushing down toward that 98 level. That 6.75% decline over the last year is the market pricing in reduced relative attractiveness for the dollar due to those expected rate cuts.
And there's a key level to watch.
You need to watch that critical technical support level at 98.60 very closely. If the DXY breaks convincingly below that, the bearish acceleration for the dollar could be, well, dramatic. As for the 10-year Treasury yield, it's stable, slightly firm at 4.15%. And this is a key nuance. It indicates the market is balancing the rate cut expectations, which should drive yields down, with a persistent belief in a soft landing. If the market truly believed a recession was coming, we'd see a sharp, panicked flight to safety into bonds, driving yields much lower. Stability here suggests resilience, not fear.
Okay, now for what I think is the most fascinating divergence in our source material. The debasement trade expressed through gold and Bitcoin. Gold is climbing, trading around $4,215 an ounce, right? It's benefiting from the weakening dollar, the central bank easing narrative.
Yeah.
A classic currency hedge.
That's right. Gold is fulfilling its traditional role as the physical hedge against currency softening. It's moving higher because institutions are worried about currency debasement, not necessarily worried about a broad economic collapse.
But then you have Bitcoin, which is trading above $91,300, showing this incredibly robust performance. It has a high correlation, a really strong plus 0.71 with the Nasdaq 100. That suggests it's acting like high beta tech. If it's trading like tech, how can institutional players truly consider it a debasement hedge instead of just another aggressive risk asset that benefits from the same loose money? That seems like a major contradiction.
That is the crucial question. You are hitting on the core of the debate. Yes, tactically, Bitcoin benefits from high-risk appetite and cheap money, making it behave like tech. However, institutional positioning suggests they are separating the function of the asset from its volatility profile.
Okay, go on.
And this is where the Harvard endowment nugget is so telling. They significantly increased their Bitcoin ETF holdings in Q3 2025 to $443 million. And crucially, they surpassed their allocation to gold ETFs.
Wow.
This signals that while gold is the historical hedge, massive pools of capital are increasingly viewing Bitcoin as the superior digital gold alternative in a world where central banks are committed to easing. The institutional thesis is that its fixed supply makes it a more reliable hedge against future fiat debasement, even if it brings along tech-like volatility in the short term.
So they're accepting the risk profile for the long-term hedging potential.
They absolutely are.
That's a powerful narrative shift, a change in what constitutes a long-term store of value for the most sophisticated money out there. Which brings us to the biggest latent risk in our sources, the systemic issue beneath the surface, the subsurface fragilities, and the emerging stress in short-term funding markets.
We have to talk about the elephant in the room. The financial plumbing is under immediate pressure. We were told the Federal Reserve's quantitative tightening, QT, ended on December 1st. This was supposed to signal a move back to stable, ample bank reserves.
But that's not what happened.
Not at all. Look at what happened immediately following the end of QT, rising stress in the repo market. The repo market is where banks lend each other cash overnight. When stress there forces the Fed to step in, it means the system is short of liquidity.
And the Fed didn't just step in, they had to inject a massive amount of cash.
Precisely. They were forced to intervene with a $13.5 billion repo injection, the second largest since the pandemic era. This is an enormous alarm bell.
An alarm bell, how?
Think of the banking system as a finely tuned engine. QT was essentially draining the reserves slowly. That $13.5 billion injection was an emergency, high-pressure top-up of oil, confirming that the engine was running dry and bank reserves are definitively not ample.
So that intervention, it supports risk assets in the short term because it injects liquidity.
Correct.
But it signals a deep underlying systemic issue that contradicts the current risk-on confidence.
It absolutely does. It means the market is reliant on the Fed not just for rate cuts, but for emergency short-term liquidity management. If that $13.5 billion fails to fully soothe those funding pressures, or if we need more interventions, that systemic fragility will quickly override the dovish enthusiasm we see in the stock market. It's the highest probability tail risk right now.
This complexity just underscores the need for agility and defining tactical boundaries. Our sources reference the implied opening range, calculated using the options market ATM straddle, suggesting a possible 1.3% move for the week. How does knowing this range inform our strategy for the immediate future?
Well, that implied range sets the market's expected volatility budget for the week. It means you should be highly skeptical of any move that cleanly breaks through that range without significant confirming volume and sustained liquidity.
So the strategy needs to be tactical.
It has to be. We need to be prepared to fade those liquidity grabs reversing quickly when we identify a false move, while aggressively confirming any clean, sustained breaks that hold above those calculated pivots. You have to prioritize confirming institutional intent over just chasing rapid price action.
So, to synthesize everything we've covered.
The market is charging into risk, fully committed to the rate cut narrative, which is weakening the dollar and fueling mega cap equities. But you cannot ignore the fragility. The gains are concentrated, derivatives show fear brewing beneath the calm VIX surface, and most critically, the foundational plumbing of the short-term funding markets requires emergency Fed intervention. The underlying structure is just tighter than the indices suggest.
That brings us to our final takeaway for you, the listener. The current environment suggests you have to be prepared for a lightning-fast reevaluation of risk if two things happen this week. First, if the Fed deviates even slightly from the highly anticipated dovish path. Or second, if that crucial emergency $13.5 billion repo injection fails to fully ease the demonstrable underlying liquidity stress we've identified in the funding markets. And here's a provocative thought to mull over as you watch the index divergence play out. If large institutional endowments like Harvard are now explicitly treating Bitcoin as a superior debasement trade hedge, to the extent that it surpasses their gold allocation in that specific risk category, what does that long-term institutional decision signal about the future utility of traditional physical assets like gold in a truly digital economy? Think about that as the market attempts to consolidate near its highs this week.